Hi, this is Roger Conrad, and welcome to Investing Daily. What I want to talk about today is the backup in interest rates that we've seen over the last couple of weeks. This has been primarily in response to concerns about the deficit from what's really been an extension of the Keynesian expansionary fiscal policies of the last 2 years in the budget bill, the extension of the Bush tax cuts. All these things are going to continue heavy spending by the federal government. Of course, the Federal Reserve is also maintaining a very expansionary policy, buying back bonds right now and keeping interest rates at very low levels. So there's been some concern there that this will signal some balanced budget busting, some possible downgrade. There was even an article in the paper regarding that Moody's would consider downgrading the U.S. government from its traditional AAA rating unless there was serious action taken on the deficit. All these things have worried people, I think, and that's kind of behind the backup in interest rates. Also, there's a concern when economic growth starts to get going that we will see more inflation, and again, that's also a reason for rates backing up. I think a lot of this is going to calm down at the beginning of the year. One reason is the fact that we've had the lowest corporate borrowing rates for decades, and those have extended well over a year up until this latest tax deal. So any corporation that's had to borrow to refinance or to finance a new project or to reduce their interest costs across the board has been able to do so at very, very low rates for over a year. So we really don't have a major push for refinancing. There are, of course, some companies out there that are going to need to borrow money. Many of them are just the usual suspects that always seem to be in the wrong place at the wrong time. But at this point, there's not really a push for refinancing, and that's, again, a very, very big point when it comes to the credit markets. It's not just supply, it's not just people's worries about, rather demand, people's worries about interest rates and so forth. It's also a matter of supply. And companies are not going to issue a lot of bonds with rates backed up. They're going to wait for rates to come back down. So we'll see how things go forward, but this is not an issue where I think people should really panic and start throwing all their bonds out. We've, of course, been very, very cautious on bonds for a long time. If you look at some of our portfolios, particularly personal finance income portfolio, we've had a number of bond funds in there. They all have very low duration. What does that mean? Well, they're just not that exposed to interest rate changes. And they keep maturities of their holdings very low. They might be the type of bonds that will hold value even when rates slide around. So we've been very cautious. And if you're in those types of securities, I think you're just fine to stick with it. There have been a number of funds and individuals that maybe got carried away, bought some 30-year bonds, 50-year bonds. Those are never a good deal, in my opinion. We have not been advising those. But if you've kept your bond exposure conservative, I don't see any reason why you shouldn't just stick with it. So thanks for tuning in, and have a very good holiday, and we'll look forward to a good year next year.